So I'm sure you've heard it. The stock market's risky, the stock market's overvalued, or the stock market is just simply not going to go any higher. However, you also hear that the stock market is one of the best wealth creators, especially when you hear about figures such as Warren Buffett that have amassed billions of dollars to the stock market. For that reason, in today's video, I'm going to break it all down and teach you how we as teenagers start investing in the stock market. Hello everybody, my name is Gerardo Astorga and I aspire to be an investment fund manager. And in today's video, I'm going to break down the key concepts that we as teenagers need to understand about the stock market. My goal with this channel is very simple: financially educate teenagers in a way that actually makes sense. Now look, before we talk about complicated subjects such as how to pick stocks or how to analyze a company, I want to build a foundation. And I will do this through explaining the importance of investing. And the answer is very simple: financial freedom. Now look, if we go on to a compound interest calculator and input an initial investment of $1,000 and a monthly contribution of $200, which that just means that every single month you're going to keep putting in $200 into the investment, with an annual return rate of 10%, which I got this from the average annual return rates of the S&P 500, in the span of 40 years, you would accumulate over $1 million. And the best part is that this can be done by anyone. Whether you want to be a doctor, lawyer, engineer, or whichever career pathway you desire, is the exact same thing as cooking. Just because you know how to cook doesn't mean that you're going to become a chef. However, it's a useful skill set that you're going to use throughout your whole life. The same thing applies to financial education. It doesn't mean that you're going to have to spend countless hours learning about finances, because realistically, you're only going to apply whatever is useful to you. With that in mind, you're probably asking, well then, what is the stock market? And let me start off by explaining what is a share. A share represents a unit of ownership in a company. So if I buy a share of Microsoft for $400, for example, with those $400, I bought a part ownership of the company. And that basically, like I just said, it gives me part ownership of the company, and now I have a claim on their profits and on their dividends if they give some. Or in other words, I own a small piece of the business. Now look, these shares live on what's known as a stock exchange. And think of a stock exchange as a grocery store. But instead of shelves full of products, they're filled with companies that you can buy. And that's basically what a stock exchange is: a marketplace where people can buy and sell their shares. The two most recognized stock exchanges is the New York Stock Exchange and the Nasdaq, which is home to the biggest tech companies. Now, don't worry, that doesn't mean they have to fly towards New York in order to buy stocks. Actually, this is done through what's known as a broker, or think of it as the middleman. Now, what basically this broker does, he is the middleman and completes the transaction from you, the investor, to the stock exchange in order to, well, buy the stock, obviously. Think of it as a digital shopping cart, which basically allows you to buy stocks through your phone. Some of the most recognized brokers at the moment are Robinhood, Vanguard, Interactive Brokers, and more. Now look, one of the key characteristics of stocks is the volatility, which basically means that they can go up or down in value. And that is based off investor sentiment. If investors have a positive sentiment or are excited about a business, that will rise the price of the share. However, if they have a negative look on the company and think for whatever reason the company is going to perform bad, the stock is probably going to go down in price. And due to this volatility, people have various misconceptions, such as the stock market going to zeros or that the stock market's never going to go higher. But think about it. The stock market has existed since World War I, World War II, various geopolitical conflicts, and it still continues to have a long-term upward trend. Why? Well, because the world continues moving on. Just think about it. We keep going out, we keep paying for various subscriptions, we keep buying different products online, and this economic activity shows up as profits for companies, which will later be reflected in the stock market. Now look, don't get me wrong, I'm not saying that stocks right now are not overvalued or that they're not going to go down. However, what I'm just saying is that I highly doubt the stocks are going to go to zero, because think about it. Do you find it realistic that Amazon, Apple, Microsoft, Google all go broke and just don't exist anymore? Do you really find that realistic? And if you do, just imagine the world without them. Obviously, I know a lot of people don't imagine that world or probably don't think like that. However, I just wanted to cover that misconception since I feel like it's a very common one. Now look, me personally, I like to find that whenever the market drops as an opportunity. Why? Because the long-term trend has always been upwards. And I personally see that if the market goes down, it's time to buy, because the world will always move on from this stuff. There will always be innovation. There will always be something, and we will move on from whatever crisis there is at that moment. And also the reason why I think like that is because think about it. You're going to buy some of the best businesses in the world: Amazon, Apple, Microsoft. And the thing is, people are saying, oh, well, you're investing in the stock market. No, you're investing in companies. The stock market is just the way that you invest in the company. This is the grocery store, but it's not the product. So you have to change your mentality from, oh, you're investing in the stock market to, I'm investing in the companies. And if you invest in the best companies, your mentality will be, well, hey, I'm buying some of the best businesses in the world at a discount. Of course, that is my personal opinion, and honestly, a lot of people have different approaches. However, that's how I like to think about it. All right, so now that we know the fundamentals of the stock market and I already covered one of the common misconceptions, I want to talk about what can we invest in. Now, I want to start off with indices. And indices is basically a basket that tracks the performance of different stocks. For example, the S&P 500 tracks the 500 most valued companies in the stock market. Now look, a good example of this is, think about it like this. Imagine that an index is like a sports team and an individual stock is just one single player. So in this case, since you're buying an index and you're betting on the whole team, you don't have as much risk as if you would have just invested in one player. Because who knows, maybe that one player could have had a bad day. And at least with the whole team, you're betting on different ones. So you're diversifying, which means that you're taking less risk. Diversification just simply means that you're not relying on one single company. Because for example, if you're investing in 10 different companies, if one goes down, you still have the other 9 that can cover you or protect you from risk. The good part about indices also is that it's a passive investing approach, which means that you don't have to make frequent investing decisions such as, oh, let me buy this stock or let me sell this stock, because you're just following a benchmark of certain stocks, for example, like the S&P 500. Now look, there are a lot of indices such as the NASDAQ, Dow, or there's also some international indices such as the DAX, which tracks some of the 40 companies in Germany, the IPC, which is the Mexican index, the IBEX, which is one from Spain. Now look, in order to invest in indexes, you don't do it directly through a broker like, oh, let me just invest in the S&P 500. You actually do it through either a mutual fund or an ETF. However, I am going to explain this in a separate video because I think it's a more complicated topic, and I just believe that it deserves its own video. Now look, the second option is individual stocks, which is my personal favorite approach because I like to analyze companies. However, obviously it is more risky because imagine it like this, like you're literally investing in only one single player. So you have to deeply analyze that player, check out their previous performance, and you have to analyze them very good in order to say, well, is this a good investment or not? Obviously with companies, it's very different from a player because in this case, the company, it has a lot of past performance. There's a lot of financials in the past. You can see how their sales have evolved, their competition, a lot of metrics. Some of the most common analysis for individual stocks is financial statements, which imagine it like this. Basically, they represent how much you make, how much you spend, how much you own in terms of assets, how much you owe in terms of debts, and then how your cash just moves in and out of the business, which I will explain in a separate video also because it's a very interesting topic on how investors analyze companies. However, as you can tell, this is a more active investing approach, which means that it requires more time, and I would mostly suggest this for people that are interested more in the topic and that say, oh, well, I am going to spend a few hours, probably every week dedicating it just to analyzing companies, for example. However, my favorite approach for people that are very beginning is a approach where you kind of mix it between both. For example, a 60% in indexes and maybe a 40% in individual stocks. However, it also depends on your personal goals and how free you are, because for example, if you just don't want to have an active investing approach and just passive, I would just highly recommend indexes. Of course, it's a recommendation. I'm not financially advising you or nothing like that. But for those that are interested in the individual stock approach, I would like to introduce you to 2 different investment styles. The first one is known as value investing, which is when you try to buy a stock under its intrinsic value. Now look, the intrinsic value is a very interesting topic that a lot of people try to analyze and everything like that. However, I suggest that if you don't know a lot about this topic, don't really look into this. But look, the intrinsic value, think of it like this. Think of the intrinsic value as a used car, for example. We can find the intrinsic value of a used car based off its car mileage, the brand, etc., right? Let's just say the intrinsic value is 10,000 and someone is selling it for 7,000. Well, it would actually be a good purchase if you buy it at 7,000. However, what if someone's selling it for 13,000? Well, it's overvalued, obviously, and I personally wouldn't buy it. However, what value investors try to do is try to buy companies with the same, analogy, like they try to apply it to companies. Let's find companies that are under their intrinsic value. So, obviously, I buy them right now, and hopefully they go up, right? Obviously, this isn't done with newer companies such as penny stocks or more risky stocks. Value investors such as Warren Buffett try to do this with big companies or companies that have very high growth potential, which is also the second method. But for now, just think of value investing as companies or it's an investing approach that tries to buy companies under their intrinsic value. It also requires deep analysis of their competitive advantages, the evolution of a lot of stuff, of different metrics. However, it is another thing that I will explain in the future video of how to analyze companies and stuff like that. The second style is growth investing, and growth investing is just kind of buying a company that looks expensive today because the future price will justify it. Think of it like this. Imagine that you're gonna buy some land in a city that's growing really quickly. And you're gonna buy the land right now and it looks pretty expensive. However, the future price will justify the future growth. And that's the difference between value investing and growth. In growth, you have a long-term vision and you try to see, okay, this company will be here in some future, and that's why it looks expensive right now, but the future price justifies it. A lot of the times, these are tech companies such as Microsoft, Google, and stuff like that. Obviously, more in the past, because obviously there was more risk in the past. Companies also like Apple, and more than anything, it's a lot of tech companies and obviously other sectors. And I actually forgot that there was a third investment style, which is the income approach, which basically means that what you try to do is find companies that pay dividends. Basically, when they pay dividends is that, let's just say a company is very mature, such as Coca-Cola, for example. And since it's a very mature company and they cannot grow as much as they did in the beginning, they now say, oh, well, how can we make people invest in our company, or how can we attract investors? And they do that through dividends. And basically, that is money that goes back to the investor. And the thing is that this approach is more for stable companies and companies that are very more mature. So growth is not going to be very much like what you're going to receive. You're going to receive more than anything dividends, or that's why it's also called the income approach, right? Now, my personal favorite approach is growth and value, because I feel like at our age as teenagers, we can obviously take more risks. And that is because of obviously the most important factor, which is time. Now, please don't take it like the wrong way and say, oh, well, let's go invest in meme stocks or meme coins and stuff like that. Like, that's not the point that I'm trying to say. I'm just saying that right now is the time that we can invest in high quality businesses that might still have some growth. For example, companies like Microsoft, Google, etc. And at the same time, I mean, yes, there might be some more volatility right now and we could take that risk compared to an adult, which might not be able to take that risk because he has more responsibilities than us. All I'm saying is that we should focus on buying quality businesses that have high competitive advantage, that have a good evolution of sales, good evolution of competitiveness, and a lot of stuff like that. So in conclusion, now you know how the stock market works, some common misconceptions, and the various investing styles. I hope you enjoyed today's video, and the next following videos will be on the analysis of stocks and obviously how different people perform their analysis, people that invest in indexes, people that invest in individual stocks. And for those that invest in individual stocks, it would be the three different approaches, which would be the value, growth, and income approach. And after the analysis video, I think, I could be wrong here, but I think the next video would be explaining obviously the broker situation, ETFs, and the various ways that, I mean, we could obviously directly place trades. So thank you so much for watching today's video. I hope you enjoyed it. Please make sure to like and subscribe and comment down below which is the investment style that you prefer. Thank you so much. Have a good day.